There's a rhythm to history that most people never notice. It's hidden beneath headlines, tucked inside financial reports, ignored in classrooms. Yet this rhythm has whispered the story of every major economic collapse for the past 2 centuries. The crash of 1873, the stock market collapse of 1929, the global financial crisis of 2008, all of them, predicted by the same hidden cycle. And now, all signs point toward 2026. Not sometime vaguely in the future, not 2027 or beyond. 2026. The alignment of history, mathematics, and human behavior is too precise to ignore. This isn't a story about fear. It isn't speculation or conspiracy. This is about cycles, vast recurring patterns that govern economies with a reliability comparable to the seasons. Just as winter follows autumn and spring inevitably follows winter, booms give way to busts, and collapses are as certain as the turning of the earth around the sun. To understand what's coming, we need to step back and look at these cycles in detail, starting with the work of a man whose name history tried to erase. In the 1920s, a Russian economist named Nikolai Kondratiev uncovered what he called long waves in economic activity. Diving deep into data that stretched back to the 1700s, he discovered a pattern that repeats roughly every 50 to 60 years, a sweeping rhythm of growth and decay. He mapped 4 phases, evocatively named after the seasons: spring, summer, autumn, and winter. Each phase carries its own character, its own risks, and its own inevitability. And right now we are squarely in the winter phase, the phase that, without exception, culminates in crisis. Kondratiev didn't merely theorize. He meticulously documented decades of production statistics, commodity prices, interest rates, and trade flows. These long waves were not random fluctuations. They were predictable systemic patterns driven by 3 core forces: technological innovation, the accumulation of debt, and the cyclical destruction of outdated economic structures to make way for the new. His findings were so threatening to the Soviet narrative of endless progress that Stalin had him arrested in 1930. Kondratiev died in a labor camp 8 years later. Yet his theory survived, quietly proving its accuracy with each subsequent boom and bust. The cycle begins in spring, a time of cautious recovery. Economies rise from the ashes of previous crises. Infrastructure is rebuilt. New technologies, once experimental, begin to diffuse across society. Debt levels are manageable because the previous crisis eliminated much of the toxic leverage. Interest rates are low and prices are stable. Optimism grows, tentative but tangible. After World War II, for example, the 1950s were a textbook spring phase. America reconstructed cities, built highways, and suburban life blossomed. Television entered households. Economic growth was steady, inflation modest, and society collectively looked forward to a brighter future. Then comes summer, the boom. Technologies born in spring reach maturity. Productivity surges. Employment is high, wages rise, and inflation begins to stir as demand outpaces supply. Wealth feels permanent, and optimism often crosses into hubris. The 1960s were America's summer. The space race, an expanding middle class, technological breakthroughs, and confidence in industrial and financial power. Beneath the surface, though, debt quietly accumulates, inflation simmers, and structural imbalances begin to form. Autumn follows, a plateau that feels like prosperity but carries the first seeds of decay. Growth slows, inflation becomes stubborn, and central banks tighten monetary policy. Sometimes too late, sometimes too harsh. Speculation overtakes productive investment. Asset prices detach from reality. The 1970s, marred by stagflation, oil shocks, and rising unemployment, were a textbook autumn, a slow slide toward inevitable winter. Winter is the reckoning. Debts that seemed manageable become crushing. Asset bubbles collapse. Banks fail. Unemployment spikes. Deflation, recession, or both sweep through economies, clearing the excesses and resetting the stage for the next cycle. The early 1930s Great Depression exemplifies winter in its purest form. Unemployment soared to 25%, the stock market fell 89%, and thousands of banks vanished. Survival depended on foresight, discipline, and sometimes sheer luck. Those who endured positioned themselves to prosper once the next spring arrived. The cycles repeat relentlessly. Spring in the 1950s, summer in the 1960s, autumn in the 1970s and 1980s, winter in 2008. But the winter of 2008 was different. Governments and central banks intervened aggressively. Trillions in bailouts, interest rates pushed to zero, quantitative easing on a scale never seen before. They prevented the natural winter from completing its purge. What they created instead was a postponed winter, a temporary reprieve in an inherently cyclical system. And here we are, approaching the end of that postponement. The accumulation of debt, speculative excess, and unsustainable valuations is reaching a point where intervention can no longer contain the pressure. The same forces that drove the 1929 crash and the 2008 financial crisis are converging, and history is about to repeat itself with remarkable precision. 2026 sits at the crossroads of multiple reinforcing cycles, each pointing toward the same conclusion: a winter that cannot be delayed any longer. To understand why 2026 is emerging as the epicenter of this next crisis, we need to examine the smaller rhythms within the long wave, the subcycles that layer over Kondratiev seasons and intensify the economic weather. These cycles are like nested gears. The long wave turns slowly, but inside it, debt cycles, generational cycles, and financial rhythms rotate faster, amplifying the eventual collapse. First, the debt supercycle. This is the accumulation of leverage over decades, stretching societies and economies to their limits. Historically, maximum debt saturation occurs roughly every 70 to 80 years. The last supercycle peak coincided with the Great Depression of the 1930s. Add 70 to 80 years and you arrive at a dangerous zone between 2010 and 2020. By the early 2020s, the world's financial system was already precariously stretched. Household debt, corporate borrowing, and government liabilities were at record highs. The warning signs were there for anyone who chose to see them. Next, the generational cycle. Societies tend to forget the lessons of prior crises roughly every 80 to 90 years, the length of a human lifetime. Those who survived the Great Depression carried an intimate understanding of risk, of leverage, of what true economic collapse felt like. Their grandchildren and great-grandchildren, however, inherit prosperity without the memory of its fragility. The last generational crisis peaked in 1929 to 1933. Add 80 to 90 years, and suddenly the world is walking blindly into 2019 to 2023. It is precisely this collective amnesia that sets the stage for repeated mistakes, speculative excess, and psychological vulnerability when the next winter arrives. Now consider how these cycles interact. They do not operate in isolation. When Kondratiev's long wave aligns with the debt supercycle and the generational cycle, their combined effect is far more severe than any single cycle on its own. It is the convergence of forces, a perfect storm of historical inevitability. That convergence falls squarely into a 5-year window stretching from 2022 to 2027, with the highest probability flashpoint landing in the middle, late spring to early summer of 2026. But cycles alone cannot pinpoint exact timing. For that, we turn to real-time economic indicators, the signals that reveal stress in the system before it becomes visible to the broader public. One of the most reliable is the yield curve. When short-term interest rates exceed long-term rates, the curve inverts, a historical harbinger of recession. Every recession since 1950 was preceded by this signal, without exception. In July 2022, the yield curve inverted, and it remained inverted for more than 2 years, one of the longest inversions in recorded history. When the curve returned to normal in September 2024, history tells us to expect recession within 6 to 18 months. That places the window squarely between March 25 and March 2020. Corporate credit spreads provide another critical signal. These spreads measure the premium investors demand to hold riskier corporate debt over safer government bonds. When spreads are narrow, confidence reigns. When they widen, fear creeps in. In late 2023, after years of compression, spreads began widening sharply, a sign that the market is sensing risk. Historical precedent shows that widening spreads lead recessions by 12 to 24 months. Add that to late 2023, and we arrive at late 2025 through late 2026, a chilling confirmation of the timeline suggested by the yield curve. Even more subtle is the velocity of money, the speed at which currency circulates in the economy. When confidence is high, money flows freely, and economic activity thrives. When confidence falters, people hoard cash, and the economy slows. Money velocity peaked in early 2022 and has been declining steadily since. Historical data shows a lag of 24 to 36 months between peak velocity and recession onset. That calculation puts us in early 2024 to early 2025, the first tremors of a winter that will fully manifest in 2026. Household debt is another timing mechanism. Historically, consumer leverage peaks just before major crashes. In 2007, 1989, and 2000, household debt reached levels that proved unsustainable when the next recession hit. Today, consumer debt is at or near record highs. Credit cards, auto loans, student loans, and mortgages relative to home values are approaching critical thresholds. When debt service exceeds roughly 15% of disposable income, a crisis typically follows within 18 months. That threshold is expected to be crossed in mid-2024, placing the inevitable fallout squarely into the late 2025 to early 2026 window. Commercial real estate is perhaps the clearest immediate signal. Roughly $1.5 trillion in commercial loans must be refinanced between 2024 and 2027. These loans were originated in a period of ultra-low interest rates and now face refinancing at 7 to 9%. The math doesn't add up. Properties cannot generate enough income to service these higher obligations. Defaults will cascade, regional banks will fail, credit markets will freeze, and broader economic collapse will follow. The peak of this refinancing cliff is projected for the first and second quarters of 2026. This is the sharp edge of the winter phase, the moment when latent imbalances finally erupt. When we step back and view these signals together, the picture becomes unmistakable. The delayed Kondratiev winter of 2008, the everything bubble that followed unprecedented interventions, is approaching its inevitable conclusion. Normally, bubbles form in a single sector: real estate in 2008, technology in 2000, stocks in the 1920s. But the interventions of the last decade inflated everything simultaneously. Stocks, bonds, real estate, cryptocurrencies, art, collectibles, all reached historically unprecedented valuations. This creates a unique peril. When the bubble pops, there will be nowhere to hide. All assets, all markets will feel the collapse together. Global debt illustrates the scale of this vulnerability. By 2023, total global debt reached $37 trillion, roughly 340% of global GDP. For perspective, U.S. debt to GDP peaked at 260% during the Great Depression. Corporate debt in the United States alone exceeds $11 trillion, much of it zombie debt, loans that service only interest, unable to repay principal. Once rates rise and remain elevated, these companies will fail, triggering cascading losses through the financial system. Government debt compounds the problem. U.S. federal debt now exceeds $36 trillion, with interest payments surpassing $1.2 trillion annually. At current rates, these obligations will become mathematically unsustainable within a few years, leaving only three grim options: default, inflation, or austerity. Historically, governments choose inflation, the least overtly painful path, but it destroys purchasing power and destabilizes economies. History shows that crises unfold in stages. They begin not with a roar, but with a crack, a subtle failure that signals the pressure building beneath the surface. By late 2025 or early 2026, that first crack will appear. It might be a major bank teetering on the edge, a sovereign debt default in Europe, or a cascade of corporate failures in China or the United States. The precise trigger is almost irrelevant. What matters is that the system has accumulated so much stress over decades that once one point fails, the entire network begins to shudder. When the crack appears, authorities will deny its significance. They will label it isolated, temporary, or contained. They will point to positive employment numbers, consumer spending, and GDP growth as evidence that the fundamentals remain strong. This is a recurring theme in economic history. In 1929, the stock market had several sharp drops before the crash, each downplayed as insignificant. In 2007, the failure of a single subprime lender was dismissed as a contained problem. Denial is an essential phase. It buys policymakers time, prevents immediate panic, and prolongs the illusion of stability. But denial is always temporary. Eventually, the system itself forces recognition. The second stage is contagion. Once the initial crack opens, fear spreads rapidly. Depositors question the solvency of other banks. Investors reevaluate countries and corporations alike. Credit markets seize and liquidity dries up. This is a self-reinforcing cycle. Fear accelerates the freeze, and the freeze amplifies fear. In September 2008, after Lehman Brothers collapsed, credit markets essentially shut down overnight. Companies could not finance payroll, and the financial system nearly stopped functioning. In 2026, this contagion phase is likely to occur during late spring and early summer, coinciding with the peak of the commercial real estate refinancing cliff. Next comes intervention. Governments and central banks will respond with all available tools, slashing interest rates, unleashing quantitative easing, bailing out institutions, and flooding economies with fiscal stimulus. Markets may stabilize temporarily. Optimism may flicker. Headlines will proclaim that the worst has passed. But this is an illusion. The intervention does not solve the underlying structural imbalance. It merely delays its final reckoning. In historical terms, the intervention phase can last anywhere from 3 to 12 months. In 2026, expect this phase to span summer through early fall. The fourth stage is the secondary collapse. This is the true winter, when the illusion of recovery shatters. Markets that rallied on intervention will fall again, often faster and further than before. Corporate bankruptcies will accelerate, unemployment will spike, and governments will face collapsing revenues, forcing even more borrowing to maintain essential services. Social unrest will grow as ordinary citizens face job losses, foreclosures, and evaporating savings. This is the heart of the Kondratiev of winter, a cleansing, systemic reset that purges the excesses of the previous decades. Based on historical precedent, this phase typically lasts 18 to 36 months. In 2026, the secondary collapse is expected to unfold from late 2026 through 2028. Finally, after the storm comes stabilization and reset. Debts are liquidated, zombie companies vanish, and asset prices return to levels supported by fundamentals rather than speculation. This sets the stage for the next spring, the slow, deliberate rebuilding phase. Survivors, those who position themselves wisely, emerge with capital and the opportunity to invest at depressed prices. Historically, these survivors reap extraordinary gains. Investors who bought stocks during the depths of the 1932-1933 depression experienced returns unmatched in normal markets. Those who acquired foreclosed real estate in 2009 to 2010 created fortunes that would last generations. The opportunities of a Kondratiev winter are rare, cyclical, and profound. But they require preparation, patience, and the courage to act when others are paralyzed by fear. Preparation begins with recognition. Those who understand the cycle do not attempt to time the exact top or bottom of the market. They reduce exposure to highly leveraged assets, build cash reserves, pay down debt, and resist the temptation to chase speculative gains. Autumn, the phase we are currently in, is a period of psychological testing. Everywhere you look, neighbors and colleagues seem to prosper. Financial media celebrates market highs. Experts insist, yet again, that this time is different. Technology has changed the rules, but history warns. The autumn phase always ends with winter. Discipline and restraint are the currency of survival. For investors, the practical steps are clear. Stockholdings should be reduced, not liquidated entirely, but carefully balanced to preserve capital. Real estate, particularly leveraged properties, must be assessed for resilience in a severe downturn. Household debt should be minimized. Credit cards, auto loans, and other liabilities are anchors that force sales at the worst possible moment. Those with significant capital should diversify beyond traditional equities and bonds. Precious metals, farmland, energy assets, and essential service businesses can provide a hedge against the collapse of paper assets. Psychological preparation is equally crucial. Winter tests resolve. When markets fall 50% or more, when panic grips the public imagination, the impulse is to surrender. Yet these moments are precisely when opportunity arises. Reading first-hand accounts from previous crises, letters, diaries, and economic analyses can cultivate the mindset to act rationally when chaos dominates perception. The ability to act contrary to panic is forged long before the storm hits. Timing the preparation is a delicate balance. Too early, and you forego years of gains while waiting for a crash that seems distant. Too late, and you are forced to sell into a plunging market. Gradual, systematic repositioning is the answer. Selling 10 to 20% of stock holdings each quarter, building cash reserves incrementally, reducing debt continuously. By the time the initial crack appears, you are not fleeing, you are ready. You are not following the crowd, you are positioned to survive and prosper. To truly grasp the scale of the impending crisis, we must examine the macroeconomic forces that have built over the past decade. The 2008 financial collapse should have been a full Kondratiev winter, a natural purge of excesses. But unprecedented intervention prevented that cleansing. Trillions of dollars were injected into the system, interest rates were held near zero, and central banks became the buyers of last resort for every asset class imaginable. The result? An everything bubble. Normally, bubbles are sector-specific. Real estate in 2008, technology stocks in 2000, equities in the roaring 1920s. But this time, everything was inflated. Stocks reached all-time highs. Bonds soared. Real estate prices escalated globally. Cryptocurrencies emerged and exploded in value. Even art and collectibles entered bubble territory. When the eventual collapse comes, there will be no safe harbor. Unlike previous crises, where some assets held value, the synchronized overvaluation across all classes amplifies the risk. The fallout will be systemic, not isolated. Global debt magnifies this peril. By 2023, total global debt exceeded $37 trillion, roughly 340% of global GDP. This is a staggering burden compared to the peak of the Great Depression, when U.S. debt to GDP reached 260%. Corporate debt in the United States alone exceeds 11 trillion, with a large portion classified as zombie debt, companies surviving only by servicing interest, incapable of repaying principal. Rising interest rates will inevitably expose these vulnerabilities. As companies default, lenders suffer losses. When lenders falter, credit tightens, triggering cascading failures across the economy. Government debt, particularly in the United States, is another critical factor. Federal debt has surpassed $36 trillion, with annual interest payments already exceeding $1.2 trillion. These obligations now surpass spending on defense or Medicare. If interest rates remain elevated, the burden grows rapidly, potentially consuming 40% of federal revenue within 5 years. At this level, the system faces only three options: default, inflation, or austerity. History shows that governments favor inflation, the least visible solution, effectively eroding currency value while repaying debt with devalued money. But inflation brings its own destruction, eroding savings, destabilizing markets, and undermining social trust. The Federal Reserve is trapped. High rates suppress inflation but risk crashing the economy. Low rates and additional money printing reignite inflation while failing to address the structural debt problem. There is no painless path forward. Historically, central banks have delayed the inevitable, temporarily postponing the pain while intensifying the eventual collapse. In practical terms, expect temporary rate cuts or stimulus in late 2024 or early 2025. A final illusion of stability before the delayed Kondratiev winter hits in 2026. Now let's examine the timing of this winter in granular detail. The commercial real estate refinancing wall is one of the clearest indicators. Approximately $1.5 trillion in commercial loans must be refinanced between 2024 and 2027. These loans were issued at historically low rates of 2 to 3% and are now facing refinancing at 7 to 9%. Properties cannot generate enough cash flow to service this debt. Defaults will cascade, regional banks will fail, and the credit markets will freeze. The steepest point of this refinancing cliff is projected for the first and second quarters of 2026. This aligns perfectly with other subcycle signals, creating a convergence of stress that cannot be ignored. Household debt is another critical barometer. Credit card balances, auto loans, and student loans are near record highs. Mortgage debt relative to home values approaches levels that, in past crises, precipitated widespread distress. When household debt service exceeds 15% of disposable income, historical precedent suggests a crisis within 18 months. By mid-2024, the global economy crosses this threshold, setting the stage for late 2025 through early 2026 as the period of maximum stress. Consumer confidence and the velocity of money further reinforce this timeline. Money velocity peaked in early 2022 and has been declining ever since. In historical recessions, declines in money velocity precede downturns by 24 to 36 months. This puts the economy squarely in the early warning window, early 2024 through early 2025. Taken together with household debt levels, corporate leverage, and the commercial refinancing wall, the signals converge with remarkable precision. The full crisis will most likely erupt in 2026. The psychological dimension cannot be underestimated. 80 years after the post-World War II boom, 97 years after 1929, society has largely forgotten the lessons of past collapses. Human behavior, overconfidence, overleverage, herd mentality remains the underlying driver of cyclical extremes. Financial tools, policy interventions, and technological advances cannot change human nature. History repeats, not because the world is doomed, but because human psychology is consistent over generations. In sum, the coming Kondratiev winter is not hypothetical. It is the logical outcome of decades of debt accumulation, artificially extended growth, and systemic financial risk. The convergence of long waves, debt supercycles, generational cycles, and real-time economic indicators points to a narrow window, late spring through early summer of 2026. Everything aligns: refinancing cliffs, consumer debt thresholds, corporate leverage, and psychological cycles. The patterns are unmistakable. As the 2026 crisis unfolds, we will witness the full progression of winter. It begins with the initial crack, then spreads into contagion, followed by intervention, before culminating in a secondary collapse. This final stage is the deepest and most transformative, when markets, institutions, and societies are forced to confront the consequences of decades of overextension. The collapse will be severe, but it is not the end. It is the necessary purging that allows the next cycle to emerge. During the crack, the first signs of failure appear. A major bank may falter, a sovereign nation may stumble, or corporate defaults may cascade through global markets. At first, authorities will downplay these signals, labeling them isolated anomalies. Headlines will reassure the public. Fundamentals are sound, growth is steady, and recovery is imminent. But history tells a different story. In 1929, early market drops were ignored until the system could no longer sustain itself. In 2007, isolated lender failures were dismissed, yet they presaged the global financial meltdown of 2008. Denial buys time, but only temporarily. Contagion follows swiftly. Fear spreads from one institution to the next, and credit markets seize. Depositors question the safety of their banks, investors reassess risks, and businesses struggle to secure financing. This phase is self-reinforcing. Uncertainty fuels withdrawal, and withdrawal amplifies uncertainty. The chain reaction is rapid and unforgiving. In 2008, the collapse of Lehman Brothers froze credit markets worldwide, and within days, companies could not pay wages, suppliers went unpaid, and global trade slowed almost to a halt. In 2026, contagion will likely coincide with the commercial real estate refinancing cliff, amplifying its impact. Intervention comes next. Policymakers will respond with every tool at their disposal, slashing interest rates, launching emergency lending programs, bailing out institutions, and injecting fiscal stimulus. Temporary market stabilization may provide hope, but it is an illusion. Historical precedent demonstrates that intervention delays, rather than prevents, the full reckoning. Central banks may succeed in calming markets for months, but underlying debt and leverage remain unresolved, setting the stage for the secondary collapse. The secondary collapse is the core of winter. This is when the facade of stability crumbles. Markets fall sharply, often faster and further than during the initial shock. Corporate bankruptcies accelerate, unemployment rises, and government revenues collapse, forcing further borrowing. Social unrest becomes widespread as ordinary citizens lose jobs, homes, and savings. This phase, historically lasting 18 to 36 months, is a crucible of economic and psychological stress. Yet it is also the phase in which the foundations for the next cycle are laid. Survivors of winter emerge in a unique position. By shedding debt, maintaining liquidity, and resisting panic, they can acquire undervalued assets at a fraction of their former prices. Stocks, real estate, and other investments purchased during this period of distress historically generate extraordinary returns. Investors who acquired stocks in 1932, 1933, or real estate in 2009, 2010 created generational wealth. Opportunity, however, requires foresight, discipline, and a willingness to act contrary to prevailing panic. Psychological preparation is as critical as financial preparation. Winter tests resolve. When media outlets declare the end of prosperity and portfolios drop 50% or more, the instinct is to surrender. Yet these moments are precisely when opportunity appears. Historical accounts from survivors of previous crises reveal a common thread. Those who understood the cycles, who anticipated the extremes, and who acted calmly amid chaos emerged stronger. Cultivating this mindset before the storm hits is essential, because in the heat of collapse, rational thought is difficult and fear is contagious. Timing is essential. Start preparation too early and gains are foregone. Start too late and losses are realized. Gradual, systematic repositioning is the key. Reducing exposure to volatile assets, building cash reserves, paying down debt, and hedging through assets that preserve value during crises. Gold, silver, farmland, energy-generating infrastructure, and essential service businesses. By the time the initial crack becomes visible, you are not fleeing. You are strategically positioned. Understanding the cycles is not about prophecy, it is about pattern recognition. Chondrity of waves, debt supercycles, and generational cycles are not guarantees but probabilities grounded in 200 years of economic history. Human psychology, debt accumulation, and systemic financial pressures drive these patterns. Technology and policy can shape details but cannot alter the underlying rhythm. The convergence of cycles in 2026, long waves, debt supercycles, generational memory loss, creates a precise window for the crisis. The warning signs are visible now. Commercial defaults rising, tightening bank reserves, falling consumer savings, widening credit spreads, and declining money velocity. The end of the cycle will surprise many, yet it is entirely predictable. Most will call it a black swan, an unpredictable catastrophe, yet the data, the history, and the mathematics say otherwise. The question is not whether winter will arrive, but whether you will be ready when it does. The cycle does not bend to hope, optimism, or wishful thinking. It turns inexorably like the seasons themselves. Winter is coming. The only question is whether you have positioned yourself to survive, to maintain capital, and to seize the opportunities that emerge from the chaos. The hidden cycle that predicted 1929 and 2008 is pointing unmistakably at 2026. Historical precedent, economic indicators, and psychological patterns converge. The choice is clear: prepare while there is still time, or wait and pay the cost when the system resets. Hope is not a strategy. Winter arrives, and it arrives with mathematical certainty.